Some startups, they have the right co-founder, they have a great team, but some startups still fail and while others succeed.
Actually, 50 to 60% of the startups just fail because of ideation. They're not able to solve the right problem. They are basically not able to build the right solution, and there is always a mismatch.
What mistakes are founders often making while they are scaling the business?
A lot of times I've seen companies doing this bad. Whenever they think of, let's say, that okay, we are now scaling, they start to kind of then start preparing for it. Then the battle is already lost. Companies which were prepared before you would maybe raise a larger round of capital and scale faster than you.
What kind of money have you guys made with the exits you all have done at FAAD?
Our biggest success story has been with a company called Battery Smart. They do about one swap every second, right? They're now, I think, valued at about 3,500 crores, something like that.
Wow. And you guys exited them?
Yeah, we exited at a 61x multiple.
60?
1x. Yeah.
Wow. And can you share a practical framework for taking calculated risks for founders? Welcome to Breakthrough Moments with Priyanka Bhatt. Today we have with us Aditya Arora, who's a founder of FAAD Capital. It's an angel network where they've invested in 125 startups, over 125 startups actually. And he's a very interesting and dynamic guy who started his journey early on. And we'd love for you to stay on to learn about his journey, about how he's built FAAD Capital, and what are some of the investing hacks that one can look for, and what kind of tips and tricks startups can learn when you look at the startup ecosystem. So Aditya, very happy to have you on my show, Breakthrough Moments with Priyanka Bhatt. Welcome to my show.
Thank you so much, Priyanka, for having me. Looking forward to an enlightening discussion with you over the next hour.
Likewise. So let's start with this very pertinent question, right? When startups are looking at raising money, what are some of the things every founder must do before they raise their first round of funding, and what are the things they should not do?
Absolutely. See, you have to understand that fundraising is also a journey, and eventually it is a longer journey, 3 to 6 months, even more than that, the time that it takes you to raise certain amount of capital. So first thing that you have to do is you have to be extremely patient throughout this process of capital raising. Second thing I think you have to do is get detached from what your startup is about, where you kind of have so much affections toward it that you accept everything right in the right manner, that even if someone is giving a critical feedback to you and you don't take it in a positive way, because of course startup is your baby, right? So essentially detaching yourself from the business and thinking like a business person, and taking critical feedback positively and implementing things which are right for the business. I think that is something that you should do. And I think something that you should not do is, I think, treat this whole process as just a capital raising process. I think capital raising is just the end product of it. The first thing is about finding the right business partners to partner with. Capital is an end product of that, right? Capital is the fuel over the system and the engine of running a business. Yeah. So essentially, I think you should look at strategic people who add value to the business beyond just capital. And I think respect them, treat them as humans, not just as a bank account, and you just become too materialistic and you just talk about capital raising all the time. Be transparent, discuss business with them, and I think
Yeah, I couldn't agree more, because every founder I've spoken to, I think they give a lot of importance and stress to the team. Correct. And the co-founder, and having complementing capabilities also helps in terms of successfully running a business. Correct. Right? So I couldn't agree more there. But when you're evaluating, say, a startup, what are the top do's and don'ts in a pitch that immediately get your attention?
So I think when I evaluate a company, the first thing that I always notice is the team slide, right? As you said, is how are you positioning your team and how well have you marshaled your troops in terms of allocating different business functions to them, right? Somebody's a founder, but that does not mean that they are the alone person running the show. There are other people as well who are supporting the founder in their journey, and it's as much as their startup as much as the founders. So very important that how you basically get the right people with complementary skill sets. So if you are, let's say, positioned well in, let's say, understanding the business side of it, so you get somebody who can build the tech side of things, right? A CTO probably, So that gives a different flavor, right, to the team and makes it even stronger on all fronts. So yeah, that is something that I look forward to whenever I see a pitch deck. And something that I don't materially look at is how big the market is, right? Because I think that's a bloated metric. In India, if we talk about particularly where we are actively investing in, every market is big, right? India is, of course, the fastest growing startup nation around the world, right? So you pick up commerce, you pick up retail, you pick up consumer, you pick up deep rocket sciences, deep sciences, engineering. Everything is peaking up at the right time in India. So I think I don't look at how big the market is. I look at how strong the founder is in that market. Because a bigger market, but a less of, but a not a strong founder would still not drive the shaft. But a smaller market, but a astute founder would still give me returns.
Yeah. And but why do you think that, some startups who have a similar mindset,
Right.
they're hardworking, they have the right co-founder, they have a great team, but some startups still fail and while others succeed? I mean, what separates the 10% of early stage startups that actually see the light of the tunnel?
Yeah, that's a good question. And if you look at the whole startup piece in India, right? You look at there was a study done by CB Insights in US with the top 200, 300 startups that shut down. And they found out that actually 50 to 60% of the startups just fail because of ideation. They're not able to solve the right problem. They are basically not able to build the right solution. And there is always a mismatch, right? Whether you're solving for a problem that does not exist, or either you're building a solution that's obsolete and not relevant to solving the problem, right? So essentially, I think that is where I think that extremely important that you see ways beyond capital. That ideation is also one of the strongest aspects through which a lot of startups fail in India, right? And second reason that came out of that report was co-founder conflicts. Sometimes when the early stage startup is growing on, it's very hard to manage expectations between two or three fundamentally different people who have come from different backgrounds, who've seen different pay cards, who did different salary checks, who've lived under different conditions at home, to get their ambitions and to get their purpose and objectives together at one place and run a startup towards a singular mission.
Right. And when you look at the entire scenario, what's happening in the startup space, when a company is scaling, what mistakes are founders often making while they are scaling the business?
Yeah. I think scale is hard, I would say, because it's not just that overnight you become a sensation. You have to prepare for that, because scale is essentially a top line increase. But to increase that top line, you need your people increase as well. You need your engineering, your tech increase as well to that level that can handle that level of scale. You need your customers, right, support team as well that can handle those increasing number of customers. So scale is incredibly hard, not from an maybe not so much from an execution perspective, but as much from a managing scale perspective, right? So I think in that phase, I think one of the things that companies find it extremely hard while scaling is to change the entire DNA and culture around scaling, right? They still think from micro first principles where they have to, let's say, broaden their horizon or think from macro perspectives. They would just think from, let's say, okay, how can I go from 2 crores to 4 crores in revenue? But essentially, if you look at scale, is not just going from 2 to 4, it's going from 2 to 100. So if you don't develop that right mindset or that right DNA inside you to scale or to handle that level of demand, essentially, it's
What you're essentially trying to say is they need to have more of a broad long term vision
correct.
rather than just think short term.
Absolutely. And then not just, let's say when you're scaling, not just hire talent, then slowly and steadily preparing yourself towards scale, like in terms of improving the processes, right? Improving the compliance, improving the internal checks and balances. It's not that overnight you become a scalable company and then everything changes by a second. Companies take time to change culture. Companies take time to hire people. Everything is scale is also a question of time.
Do you think like overstaffing or being, as you said, being prepared in advance helps, right? So do you think overstaffing or being prepared for that when you go in the battlefield and actually go for the kill, You need to be over prepared. So do you think hiring talent much before you actually develop the product is important as well?
I think so, yes. Because if you look at once the scale is done and then you're hiring talent, you would not have time to even nurture that talent. That talent would be out there in the battlefield then, just to keep the numbers up, right? And then you expect that person to blend in with the culture, to blend in with that scale, right? Because a lot of times I've seen companies doing this bad. Whenever they think of, let's say that, okay, we are now scaling, they start to kind of then start preparing for it. But then the battle is already lost because then companies which were prepared before you could maybe raise a larger round of capital and scale faster than you.
Yeah.
Or maybe if you bring in someone else, that person says, okay, this is such a stressful organization that from day zero I'm just bloated on targets and targets. Nobody would retain.
Yeah.
Even if you want to scale, but there are not people sticking with you, how would you scale essentially? Yeah.
So tell me, when founders are scaling their business, let's not talk about scaling, but when they're starting their business,
Right.
what are the things that they should focus on in the early stages of the business
Correct.
vis-a-vis their growth stages? It could be mindset, for example, it could be team. Do you advise, can you give me some tips on how they should pivot from, say, early stage to growth stage?
Yeah, Priyanka, I think there's no one size fits answer to this because scale is different from every sector, every company.
Yeah.
But essentially, the macros of the startups say that while you are in an early stage, your objective is to bring out the prototype and get a feedback on it. That's the seed levels kind of validation you're looking for. Then once you move to a, let's say, a pre-series A stage, or let's say once you're actually finding your feet and trying to find customers, then essentially your early adopters become your main metric. That, okay, can I find the first 100 customers that can adapt to my product, right? Then once you find those 100 customers, you get their feedbacks, you evolve the product further. Then the question comes in, can you stick these customers with you? It's not just about transacting once with them. It's about transacting with them over multiple life cycles. So once you're scaling at a series A stage, your retention with increasing revenue, of course, becomes the focus. Then once you've focused to 1,000 customers, your focus completely changes. Then you're not just focused on increasing revenue or customers. You're focusing on, can I enter into sub markets as well? For example, if I'm developing a skincare product, can I go after hair care? Can I go after other dermat products? So yeah, I think the metrics evolve with time, and that's how you move from one championing one product in one market to championing multiple products in multiple markets. That's how you define from an early stage startup to a late stage company that's possibly going for an IPO as well.
So, how do you approach investing in a company when the shareholding pattern is not entirely clean or transparent? Sometimes, say, the board does not even come for meetings.
Right.
And when I have been talking to so many startups, I have been seeing this commonality.
Correct.
That sometimes the shareholding is not clean, they are not structured, they're not in alignment with the investor.
Correct.
So, what do you do in such cases?
I think what we do is we try and see that, okay, how the shareholding can be favorable for all shareholders, right? Not just the founders, not just the investors, but for everyone. Because see, essentially everybody is taking a risk, right? Shareholding is nothing but a risk that someone is taking in a startup. The founder is taking a risk. The other investors are also putting their money and taking a risk as well. So you have to make sure that the shareholding is not just favorable to the founder or to the investors, but a win-win for everyone. That's the intent and motive with which you enter into any negotiation. I think the second thing is shareholding becomes a participatory right depending upon the value add that you do in a company. If an employee, let's say, becomes a co-founder tomorrow and adds that value in the company, they get access to a larger seat on the table or a bigger shareholding. But if somebody is not adding that kind of value, they don't even deserve to be your advisors as well, right? So essentially, I think all of this has to also be mapped off what value you can provide to the business apart from just capital, and are you justifying that value? Because if there's always an opportunity cost, right, Priyanka?
Yeah.
That if I'm giving you 10%, could I have given it 10% to someone else and gotten more value Because capital, what you will be putting, what the other person would be putting, the money is the same, right? The currency does not change.
Absolutely, as you said, it's all about value creation and
Correct.
what the person is adding to the organization.
Correct. So it has to be representative of that. So that's how we talk about cleaner cap tables and structures. Yeah.
Right. And you also you mentioned to me sometime back when we were having a chat that you also manage a fund.
Correct.
So what are some of the do's and don'ts in investor relations, especially when say you're a GP and you have so many LPs and so many other HNIs or investors who are, investing in the fund. So what are some of the do's and don'ts in managing those relationships with say LPs?
I think a good question again. I think the first do is when you're managing or talking to all of these LPs is to firstly understand, okay, what school of thought also they're coming from, right? And see how they're adding value as well. So, right. So, like, what's their background and how do they understand? So, I think first is KYC, as we talk in banks. KYI is what we talk in investing world. Know your investor, right? So you should have your KYI done very, very well.
What are the parameters that you look at when you get those investors on board?
I think first is again, what background to this, what channels they can open for in a business, what is their investing style and methodology as well, like are they active investors, passive investors, what kind of companies, what kind of sectors they look at. It's like putting a menu out there, right? Whether you want to have continental, when you want to have Indians, and then deciding, okay, what's your favorite dish, what's your favorite sector, and trying to find a gap and trying to find a match and an alignment inside there. So I think that is what we look at, and I think you have to be patient in finding those right investors. And I think at FAAD we've been incredibly proud that we have so many of these investors with us. I would say it's a small knitted community but a growing active community of so many like-minded investors who continue to kind of invest with us and add value just beyond capital. Right. And that kind of shows in our track record as well, because we have helped these companies not just scale and go to the next round, but also grow their business and create the impact that they sought out to when they started.
And what sort of exits have you seen with your experience?
Yeah.
What kind of exits, what kind of money have you guys made with the exits you all have done at FAAD?
Correct. So I think our biggest success story has been with a company called Battery Smart. I can share that. I think we invested in that company when they were literally, I think, one swap station. So to give context, they swap batteries. So they swap lead acid batteries with lithium ion batteries to give electric vehicles like a better runtime, right? Yeah. So when they started, there were just one swap station there. They were swapping that in swap stations across Delhi. And today, as in my numbers could be a bit off because that company has grown to such a level. They do about one swap every second, right? So
wow.
Yeah,
that's phenomenal.
So they've been like they've gone massively in terms of swap stations, I think, and they're now, I think, valued at about 3,500 crores, something like that.
Wow! And you guys exited them?
Yeah, we exited at a 61x multiple.
61x,
yeah. Wow. So yeah, within 4 years, generating an IRR of about 370%.
So you wish you would have held on to that even today.
I think if we had wished, I think we would have invested all our fund in them. So I think there's no ifs and buts in investing. There are just learnings, and I think we've been very happy and satisfied that we could generate that much of outcome, and good to see that it's creating impact also out there.
So is your investment style more of putting your eggs in different baskets, or is it like, oh, we'll only look at say 10 or 15 or 20 startups to invest in?
Yeah.
Because the success ratio says that if you invest in 100 startups, maybe one will work.
Yeah.
So how do you look at investing?
So I think our investing philosophy is, I think, of course, we diversify. We are sector agnostic, so we invest across all sectors and look at all sectors with equal relevance and focus. I think our investing style is, come in as early as you can in companies with probably any stage, right? Any sector per se, and then put entire bet on the founders, like most of the bet on the founders, study the market also, study the trends and everything, but I think still going with our larger bet on the founder that okay, this can drive the outcome.
Right.
And yeah, and I think look at every, like, keep your eyes shut, right, and your ears open,
Yeah.
and then see okay, what's the chatter, and okay, how's somebody doing their business, and just continue to be active investors in them.
And during your global expansion phase, you also expanded to Dubai, a market like Dubai, Middle East. So, why do you think Dubai was the right choice for you?
Yeah. See, I think, we do have our investors, our regional partners who very actively help us, support us, are our guiding mentors based in Dubai. And of course, that was one of the hinge, I would say, that to kind of hunch to kind of go out there. But I think Dubai as a market is very closer to what the Indian markets are. Dubai is, I think, what I think is from a startup perspective, what India was maybe 10 years back, Dubai is at there right now. And I think Dubai has everything to become India 10 years from now on. Very huge expanse of Indian population there, right? Markets which are very similar, I would say, to an Indian buying diaspora, because most of the diaspora is Indian. The laws, regulations are extremely favorable. Although now I think the corporate tax rate is coming, so
Yeah, now from 9% they've increased it to 15% now.
yes, correct. So some of my friends, they call me in Dubai and say we're not happy with what's happening, but yeah, still the kind of laws, the kind of ease of doing business, right? Had my friends setting up companies in Dubai, and they say the process is so easy, right? It's so smooth, right?
And things happen very quickly there also.
Correct.
Unlike India, where you have to keep waiting for
Yeah,
licenses and the
correct.
entire process to happen.
Correct. So it's a market definitely worth investing in, I would say, and a market worth chasing.
And what kind of advice would you give to someone who wants to look at investing abroad in other countries as well? Say, besides Dubai, do you think like US, UK, Europe, are you eyeing those markets also? Is it a good investment opportunity for investors?
Definitely, yes. I would say yes. US is still the mecca of startups. Those are very, I would say, very long drawn experience markets. Something that has been there for many years now, many decades and centuries now. So I think once you go there, you have to understand the market before you invest in. Similarly to a founder, right? The founder journey also, you have to know the market before you actually build a product, and then that investor has to know the market before they invest in, because the rules of the game change, right? And in a US, the exit horizon, exit expectation, everything would be fundamentally different from an Indian market, because Indian market, you would look at okay, how did the company scale from this to that, but in US the scaling up would be faster, the dollar value would be higher. So every calculation changes with time, right? The founder's pedigree and the founder's way of doing a business changes with time as well. In US, you would see founders doing business in a bit of a different way than Indian ones. Yeah.
Right. Let's talk about mindset versus the idea. What do you bank on more? Do you rely on the founder's mindset more, or the idea itself? What is more important for you?
Honestly, if you ask me to pick one, I would, without even thinking like a fraction of a second, I would say mindset, because ideas, although important, of course, but ideas is something that anybody can kind of have in their mind, right? Ideas are not patentable, not defensible. So it's the mindset to execute that idea. It's a mindset to stay with that idea for longer. Because in the startup world, everything you would see would look lucrative. कि ये भी कर लो, वो भी कर लो, अच्छा इससे भी मार्केट बन जाएगी, उससे भी मार्केट बन
Because
जाएगी.
there's so much of distraction, right? And
So much of distraction. So this is what I say to my founders, my portfolio founders also, right? There is a music and there is a noise, right? Music is something which helps you to push the business faster in the right direction. Noise is everything that takes you away from it.
So how do you when you talk about numbers, how do you measure growth, say beyond revenue? Are there any qualitative signals that you look at, which founders should focus on?
I think beyond growth, beyond just revenue growth, as I said, in fact, I'll be happy to tell you this concept. I teach this at universities also, right? whenever I teach my class, I tell them, see, in business would have multiple kinds of growth. One is a revenue growth, which is the most obvious and the most visible.
Yeah.
Second, of course, is the team growth, where you would see your head count, your people increasing with time. Third is a market growth, which is not visible till the time you list in a market, because your market share is minuscule, but does not mean that your market share is not increasing. We can't say that HUL and Nestle haven't lost market share to new age D2C companies like Minimalist, like Mama Earth.
Because you're essentially saying you're a small fish in a big pond, and there is so much of room to play around with, even for new entrants to come and join that bandwagon.
Correct. So that market share would maybe increase by 0.0001%, but slowly you would start to see this. And once you go public, you would see your market share listed and everything would be there, right?
Yeah.
So one is a market share growth. Then one is an operations growth, which is the most invisible aspect, which is what I said, preparing for scale, right?
Yeah.
That is systems, processes, compliance, right? What you say in your boardroom meetings, how much, what an employee 9 to 5 was doing 1 year back to what an employer 9 to 5 doing is right now. Because it's a combination of finite number of people and finite time. Everybody has 24 hours to scale a startup. You can't say that I can work 48 hours and my valuation would be 4,800 crores. So essentially then it's a matter of prioritizing your task and doing that work in the right manner. That scales the company. And this is something that has been validated by multiple founders. Had we chased that market, we would have become, or had we pivoted at the right time, we would have become this 1,000 crore company. So is that revenue we're talking about? We're not talking about revenue at all. We are talking about operations growth. You would have changed the altar of your operations to a new lens.
Right. So you spoke about revenue, you spoke about people,
Correct.
you spoke about operations.
Correct.
Does marketing fall into this umbrella anywhere?
Absolutely. When I talk about operations, I do a large level blanket of marketing and operations, right? The entire industry always, it's O&M, right? Operations and marketing. So marketing is extremely crucial. But I think marketing is also about understanding, okay, what your product eventually want to sell is.
Yeah.
But I think in today's day and age, it's crazy you asked me this question, and I was reading this post by Shantanu Deshpande as well from Bombay Shaving Company and multiple founders that today's day and age, marketing has become so much personalized, right?
Yeah.
So much curated that even without talking about the brand, you are talking about the brand.
So let's talk a little bit about setbacks, right? When a founder says facing a setback in the business, what are the tips you advise them in terms of maintaining focus, energy, and momentum in the business?
Yeah, I think there's this, like, I can be a bit philosophical in answering this question, but there's a very good quote that I learned was that it's not a matter of how many times we break down, it's a matter of how many times we get up and break through, right? So extremely important.
That's why my show is called Breakthrough Moments.
Oh yeah. See, I did a unintentional plug-in of your show right now.
Well, that was the intention of this breakthrough, and
Correct.
we're going to have something very exciting at the end of the show, which I'm not going to reveal now, about breakthroughs and breakdowns.
Wow. You're all excited. So I think when a founder goes through a setback, I think, you go back to the basics and like, I want to get to the root cause of the problem, that why this setback was created. And then maybe do a reverse psychosis of saying that, okay, this setback was because of this. And if we correct this, again, that data guy comes into picture, right? If we do this can get corrected. But some of the days, that's why I said you have to get emotional also. Like, because a founder said, okay, Aditya, I have done all of these. Still, I have faced a setback. Now, what should I do? And then you have to talk to them, not just as a founder, investor, you have to talk to them as humans. Because for me, it's just an investment, right?
Yeah.
At the end of the day. For them, it's like, for the founder, it's their life. It's their
And it's mental fatigue also, no?
It's mental fatigue, right? I honestly, you could ask me this question, you have 125 companies, right? So, आप तो किसी में भी पैसा बना लोगे. That's correct, right? वो फाउंडर के लिए वो जो मेंटल फटीग है, मेरे पास तो टाइम भी नहीं इतना होगा कि वो मेंटल फटीग मैं उसे दे पाऊँ कि हाँ, बट एज अ पर्सन आई सिट विद देम, ट्राई एंड अंडरस्टैंड कि what has went wrong, what we can do, and also telling them to hit the brakes when it is there.
Yeah.
Not just doing motivation honestly just for, this is something that I've realized कि उसको सिर्फ ऐसे नहीं just go with the mindset कि हाँ इसको आज मैं impress करके निकलूँगा कि हाँ ये कर. Although that's in my vested interest, but sometimes I think that does not work. And that's about then lying and become materialistic.
Yeah, I think it's all about integrity. You want to be.
Integrity, correct.
It's very important.
I would not want the founder to curse me saying कि yeah, this person did not appreciate me enough, right? Or this person did not kind of just kept me pushing when I did not want to.
Yeah. Right. And can you share a practical framework for taking calculated risks for founders, and founders can probably apply this in their business? Is there a framework that you would advise them?
I don't maybe would not have the framework, but I think something that I can take as an example from the book, right? That we have, that I've also recently written, and we would love to talk. We'll talk, of course, more about it as well. Is when I interviewed the founder of BharatPay, right? Shashwat is a dear friend of mine. Asked him, you actually dropped out from your engineering at IIT Delhi, is like the best, second best college, right after IIT Bombay, as in who drops it out? Right, it's a dream for many. Like 10 lakh people sit for the IIT exam. So he said, yeah, on the hindsight, if you look at, everything was an ultimate risk in life, right? But then his opportunity or a calculation was simple, right? The UPI came in India, everybody was solving for customers. Nobody was solving for merchants. Eventually, customer paise denge kisko? Merchants ko, right? And then he saw that problem and saw that, okay, UPI is there, but UPI between different apps does not work. If I have to pay you via Google Pay, you need to have a Google Pay in your phone. If I need to pay you via Paytm, a Paytm needs to be in the phone. Yeah. And that does not happen every time. India has so many apps, right? You can't have the same app on practically every phone. The interoperability is what we call it in the technical parlance, wasn't there? Took a calculated risk, went outside the markets of Delhi, in Hoskas, where IT Delhi is there, went outside that markets and started actually talking to printing machines, right? Because they were the ones who needed UPI the most. Printer shops, 1 or 2 rupee change, they did not have that. That's how he started. The chapter is called Acquiring Your First 100 Customers. That's how he started. Right? That's about taking a calculated risk. He saw that problem, went for it, and now it's a unicorn company. Right. It's something like startups, like we glamorize saying that startups are all about, okay, a totally different fundamental idea. No, it's not that. It's about finding a gap, finding a problem large enough. Is that customer willing to pay for that problem and solving it in the best way possible? Correct. That's it.
So welcome to Breakthrough Moments, and I have with me Aditya Arora, who's a founder at FAAD Capital. And as I mentioned on the show earlier, that we have a surprise element, and we've done this before on a past episodes where we've played this game of snakes and ladders, where you will get to understand the founders' breakthrough moments and their breakdowns. So let's play this game and understand Aditya's journey of what kind of breakthroughs and breakdowns he has undergone while he's built the company. Okay, Aditya, maybe you can start first. You can roll the dice.
Damn.
Okay, 6. 1, 2, 3, 4, 5, 6. Worst mentor advice.
I think the worst mentor advice has been for me that build a business for valuations and not value. Because the moment you start building it for valuations, the next number is always higher than the previous one.
So true.
Yeah.
Awesome. Okay. 5. 1, 2, 3, 4, 5. Okay. Regret you can't forget. Okay. I'm so not prepared for this. I think it was one of those moments where I regret losing a client.
Oh, okay.
And of course, I gave importance to my team because the way the entire episode happened, it was in a very condescending tone.
Okay.
Because we are an all women's team.
Oh, wow, lovely.
We're an all women's team with just one male member.
Wow.
So I gave importance to my team and stood up for them over, someone who paid me the highest retainer.
Oh, okay.
And I invited, I'm not going to name this company, but I invited this gentleman who was probably 20 years older than me to a coffee shop. And I told him, I'm going to resign your account.
Okay.
I don't need your business.
Oh.
And this is exactly what I said to him. I said, I'm not going to self-respect for me is everything for my team and me. And the way you handled that situation in that board meeting where my team members actually cried was uncalled for. And you could have handled this in a better way. And I'm going to write a resignation email where I am resigning your account. I don't need your business.
Wow.
And maybe you need to change your style of the way you deal with people. And maybe that's a lesson taught. And I walked out of the meeting head held high.
That's courage. That's sheer courage. And
that was my highest paying account.
wow.
At that point in time. And for me, self-respect is everything.
Absolutely. Yeah. No, nothing comes over self-respect.
And somewhere in hindsight, I felt that was a regret that, I lost that account. But in hindsight, I know that the way I stood up for my team was more than anything else at that point.
Yeah, business business would give you even more for this. So
And sometimes you got to take, I think, tough decisions. Right?
absolutely.
And I think this was one.
Absolutely.
Your turn. 4. Okay. Mistake that made money.
Oh, nice. Yeah. So essentially, I think I'll not, of course, name the deal, but in one of the transactions, I had told that we have a high amount investing than it what it actually was, and it ended up generating even more higher amount than what we had planned for.
Yeah.
Because the investor got into FOMO also with us that okay, yeah, this is a good deal because you guys are investing this much, we should invest. So that was a mistake that actually made more money.
Amazing. Nice. 6. 1, 2, 3, 4, 5, 6. Okay. Your turn.
6 again.
Okay. Viral moment changed business.
Yeah, I think I would say the COVID-19 viral, COVID-19 virus, it changed business for us. Yes.
Yeah. Okay. Thank you so much. This was so much fun.
Yeah.
And it was really lovely to have you on the show. And I really had a really good time having this conversation. So thank you.
Thank you so much for inviting me as well. It was like literally a pleasure to be with you. And
Thank you.
Thanks for asking the uncomfortable questions.
So guys, if you've liked these uncomfortable questions that we've asked on our show, and if you like these game formats, please do drop in your comments and tell us how we can improve. Till then, please do subscribe and like to our channel Breakthrough Moments with Priyanka Bhatt on YouTube and Instagram. Till then, keep building, stay curious and stay inspired.